I'd like to start by having a quick review of the attribution rules. Attribution rules in the form of a fill in the blanks. So there are three possibilities. Let's say that someone makes a gift to their spouse or to a child, and there's two possibilities for a child. It's either a minor child, so someone 17 or younger, or an adult child, so 18 and over. And if it's a sale at fair market value, is there attribution of the income earned? So let's say that the person makes a gift to the spouse. Let's say it's $1,000 cash, and the spouse invests it and earns interest. So that would be this scenario here, a gift. Is there attribution to the person who made the gift if it's made to a spouse? Yes?
Is there a difference between whether you give cash to someone or the actual asset?
Excellent question. Question is there a difference between giving someone cash or giving someone an actual asset? No, there's no difference. If the person who receives the gift takes the cash and invests it, it's the same as getting, let's say, a stock, a gift of a stock.
But if it goes into like a common savings account, then how do you tell, well, gain 10% from the gift or whatever?
Common savings account, let's park that one and I'll come back to it. Let's just take the pure case now where someone has made a gift to their spouse. Is there attribution back to the spouse on income earned by the person who received the gift?
Yes.
Yes? What about a gift to a minor child? Is there attribution back to the giftor
Yes. Yes.
of all types of income?
Not capital gains.
Yes, X capital gains. By that I mean yes, except capital gains. Is there attribution back on a gift to an adult child?
Yes.
Why?
Because it's not at fair market value.
Any other ideas?
Wait,
Isn't it at fair market value?
The answer is indeed no. There is no attribution back to the giftor on income earned by an adult child, the income that's earned on the gift going forward.
Say that again?
Sure. Your children adults?
One is, one isn't.
Oh, excellent!
How exciting.
So give $1,000 to the adult child
Yes,
and they earn interest on it.
yes,
That interest stays on the adult child's tax return.
okay,
Give $1,000 to the minor child, he earns interest on it, that goes on your tax return.
but capital gains goes to both. Both children will have to pay capital gains on the amount going forward.
Correct. Both children, if they invest to earn capital gains instead, sticks on their tax return.
That is helpful information.
Now, what if instead of is that everybody okay before I go on? Yes.
in any case, when you actually gift the property or whatever, it counts as you selling it to them, like for gains or whatever?
It is, but we're not there yet. This is about the income that's earned on the property after the gift or after the sale. Not talking yet about what happened on the actual transfer, okay? This is the future. I'm starting with the future, and we'll come back to the past in a minute, or to the present. Yes?
I don't know if you did, is interest earned on income attributable?
Interest earned on the gift is attributable, but interest earned on the interest, the second level of income, does not get attributed. Does anybody remember in the textbook where it says that? On page 333, there's an example, and this is actually a spouse example. And it says in the middle of the analysis part, to the extent that the spouse invests the dividend and capital gain. So there was a gift, and then the spouse earned a dividend and a capital gain. Those got attributed back to the giftor, to her husband. But to the extent that the spouse invests, I'll say reinvests, the dividend and the capital gain, the income on the reinvestment will not be attributed back. So attribution only happens once. It doesn't happen on income, but it does last forever on the first level of income. So this gift might produce dividends and capital gains forever. Forever it gets attributed back to the giftor's tax return. Yes?
What about when the minor becomes an adult?
When a minor child becomes an adult, then we swing from here to here, and there's no longer any attribution. So it's only for years before the minor turns 18. Question on joint accounts. Beyond the scope of this course, it kind of depends where the money came from. If the money came from one spouse, went into a joint account and then reinvested, really it should get attributed, or the income reported on this tax return of the spouse from where the money came. But ask me your question again.
Well, I was thinking more like just a cash gift of $1,000, and let's say it's the child, puts it in their bank account and they get their savings interest or whatever.
So who made the gift? A parent?
The parent, yeah.
Put it in a bank account for a child?
Yeah, wrote a check to the child and said, here you go.
Is the child a minor?
Sure.
Okay.
So.
Then
that-
which column are we in?
Yes, except capital gains.
Right.
But if they decide to buy an investment of any kind, how do you know that specific $1,000 went to that investment? Couldn't they have taken some of their own money and put it so how would you attribute an investment if it came out of a big savings account or whatever?
So let's say the child has $5,000 of their own money somehow, and the parents kick in $1,000. Now the child has $6,000 worth of savings account that's earning interest, right?
Yeah.
At the end of the year, the child gets a T5 slip, and everybody knows that $1,000 out of the 6 came from the parents, but what do? Do we report some of it on the parents or all on the child or what? I would be inclined to track it and report 1/6 of it on the parent's tax return.
Okay.
Or set up a separate account, which is actually easier.
So if the child bought the dividend stock,
Right.
I mean, they had it, let's say they only spent $500. I mean, they had the money before they got the gift to buy out their own money, so how do you know whether it's?
Because we're accountants and we just figured out some tracking way to do it. There's no special rule or anything like that. We just whatever sort of makes sense.
Okay.
Yes.
Children over 17 years, does it always mean 18 years or 17.5?
18.0. So it literally means 18. I honestly don't forget what happens in the year when a person turns 18. My questions to you will always be somebody who's like 16 years old and somebody who's 25 years old. I think it's possible that if someone is a minor at any time of the year, there is attribution of this. And I don't know if it's just for the number of days until the birthday. That's my guess, actually. Or if it's for the full year during which they are under 17, under 18. But don't worry about it. But if you're making a gift to a person under 18, look into what happens in the year that they turn 18. You might actually get a good result, or maybe it's not as good as you think. Anything else? Thank you.
Are we gonna do the fair market value?
Yes, I'm sorry, I forgot. Same columns. And the question is there a rollover for the giftor? Rollover, again, means, is there a taxable disposition? Do we have to pay capital gains tax?
We being the gifter?
We being the gifter. The person who made the disposition, they're the only person who can be taxed in a capital gains situation. So the same people and the same situations sell at fair market value or a gift. And the question is there a rollover for the giftor? Spouse, no if we sell at fair market value. Yes if it's a gift. The rest of this is easy. No rollovers at all on a transfer to anybody other than a spouse. Children, brothers, sisters, fathers, professors. Any questions on that? Now in this case, yes?
The rollover again, rollover. What does that mean?
Rollover means is there a capital gain? Yes, there is a rollover, therefore no capital gain. No rollover, yes, there's a capital gain. So when I make a gift to my spouse, I get a rollover. That means there's no capital gain. My spouse's adjusted cost base, whatever my original cost base was. So she'll pay tax, or there will be a capital gain at the time she sells it. Who pays tax on that capital gain? The giftor. So a gift, no capital gain at that time. I got a rollover. But when she sells it, the attribution rules put the capital gain back on my tax return. Plus, if she earns interest or dividends or whatever. Yes?
So how do you split that up? So let's say you give it to your wife and you have a gain of $1,000 on it. She holds it for 3 years, gains an extra $500 on it. Is it only attributed back for the 1,000, or is it attributed, or you just get stuck with all 50?
I just get stuck with all of it. So, as you said, if I've got an accrued gain inside what I give to her, and she sells it at a higher amount, it's not just the higher amount that gets attributed back to me. It's as if I owned it all the time. Therefore, my cost base is what counts, and it's my tax return that opens wide to receive the capital gain. So there's no sort of valuation kind of happening at that, say, $3,000 level, if that's what the amount of gain is at the time I gift it to her. It's just like the whole thing just comes rolling into my tax return. On the other hand, if I sell to her, I get a capital gain. There's no rollover. But her adjusted cost base is now this amount. And it is she who will pay tax on the increase in value before she sells it, because there's no attribution back to me. So if I buy something for $1,000, today it's worth $3,000. I sell it to her at fair market value. I have a capital gain on my tax return of $2,000. And then if she later sells it for $4,000, she has a capital gain on her tax return of $1,000, and it doesn't come bouncing back to me because the attribution rule doesn't apply because it was a fair market value transfer in the first place. Yes?
So earlier you had me mention that when the spouse goes ahead and sells it, that the capital gain does go back.
Only in an attribution situation caused by a gift.
Okay.
If I sell something to her, there's no attribution, there's no bounce back to me, but I have to pay tax on the capital gain now, there's no rollover.
So when you sell something to her, the only time you would be able to recognize a capital gain is on the sale of that item to her, whereas in the other situation, you can't recognize it immediately. You have to wait for the spouse to sell it and then recognize the capital gain?
Correct.
If
If-
there is a capital gain, that is.
If I sell something to her, I have to report the capital gain now. If I gift it to her, there's no capital gain. There's no taxable transaction actually until she sells it. And then it all comes blasting into my tax return.
Thank you.
Yes?
If it's sold somewhere like in between gift and fair market, is it yet to roll over?
So for example, if she pays me half of what it's worth, that's still a gift.
Okay. And then her cost base is 0 or?
It's what she paid me. Do you remember why that is?
I think I remember, yeah.
Why?
I don't know, it was somewhere in the tax act.
No, the point is it's not in the Tax Act. It's not in, there's nothing in section 69, so the cost base to her just becomes whatever she paid for, the proceeds that she gave to me. The lower amount of proceeds as compared to fair market value. Good question.
But then the gain is not, it wouldn't be recognized until she sells it.
Correct, the gain's not recognized until she sells it. Which opens up a very interesting question. Does all the gain come back to me? Because she did pay for part of it. I think it does, actually. Any other questions? Yes?
So then, in that last example, since she paid you less than what it was worth, would your ACV then come down to the lower amount? And then all the tax would come back to you? Or would you keep your ACV?
Since the ACB, since she paid somewhere between my ACB and the fair market value, right?
Mm-hmm.
What does section 69 say about that? Because like her cost base we've covered, her cost base is whatever she paid for it. But what's my proceeds? No, my proceeds are fair market value. The ACB will always be her, what she paid for it.
So are you referring back to the chart that you showed us the other day about non-arm's length transactions were,
In between?
fair market greater than, less than fair market value? So the spouse goes into that grouping if it's not either a straight out gift or a fair market, if it's in between, it just falls into that table?
It does. It falls into that table because that's, I think you asked me a question about inadequate consideration.
Yeah.
This is exactly an adequate consideration. It's some consideration, but not the full fair market value. So it does go into that table. It's just that there's a rollover because there's a gift. And I'll be honest, I don't know exactly, because I've forgotten, I could look it up, but we don't have time today, as to what happens on that. But there would be a rollover and there would be some kind of attribution going forward. I just don't know that it's the full attribution.
So we should assume that there'd be rollover in those cases too?
Yes, because there is a gift involved.
Okay. So it's only not rollover when it's at fair market value?
I believe so. But I'm not going there in this course. There won't be any hybrid questions about what happens going forward if she paid, say, half its value. I just want you to know about full-on gift or full-on fair market value.
Good to know.
I'd like to move on if that's all right. I'll be happy to answer any other questions on this after class. Page 374, the capital gain deduction. For people, for individuals and families that own private companies, this is their single largest tax issue, tax opportunity.
Well, it talks about qualified farm property too, so do farmers by and large use this as well?
Yes, they do. I just want you to know about non-farm businesses. And the issue here, or the good thing here, is that I can have a lifetime exemption on capital gains for $750,000 of capital gain, or $375,000 worth of taxable capital gain. So in simple terms, if I start a business, corporation, and my adjusted cost base is like $1,000, that's how much I subscribe for the shares from Treasury. And if I sell the business a few years later for $751,000, that's a tax-free transaction. So it's really significant. If my tax rate is 45%, I've saved tax based on $375,000 capital gain times 45%. You can do that math. It's probably about $180,000 tax saved. So it's really a big deal. And people are very careful to make sure that their companies qualify before and when they sell them. So the capital gain exemption. It's called in the textbook the capital gain deduction. I might call it the capital gain exemption. It's the same thing. Please pull out your calculators. So the best way to learn this is with an example. And here's a hypothetical balance sheet. So it's a corporation, and cash is $20,000. Inventory, $5,000. Receivables, $10,000. Fixed assets, 100,000. Marketable securities investments. I'll just call them investments. $20,000. So total book value of assets is
155.
155. Accounts payable?
Is that to see if anyone's awake when they're watching it?
No, it's to see if all the numbers fit on the viewfinder. Director.
I didn't do that when I tested it. Oh, I lied, I did.
Accounts payable 8,000, mortgage payable 30,000. And how much is total equity? Thank you. Somebody has offered to buy this company for $280,000. Please look at the second paragraph on page 374 under the capital gains deduction. So it says a qualified small business corporation must be a small business corporation at the time. Do you remember what a small business corporation is? We talked about that in the context of Abel's a while ago, chapter 6.
90% or more of the assets must be involved in an active business.
So 90% or more of the assets must be used in an active business carried on in.
Canada.
And where does it say this?
118 somewhere, I think.
Section 248. There's a definition of small business corporation. Can everybody turn there?
Oh, yeah. Two
248.1. So it starts out, it needs to be a Canadian-controlled private corporation. And all those other details apply. So it's a company whose the fair market value of its assets are all or substantially all, 90%, used in an active business carried on in Canada. Does anybody see any assets on here that might be a problem? Yes?
The investments, the 20,000.
The investments, the 20,000. We have to look at that really carefully because right now, based on these numbers, these investments are more than 10% of the book value. So we have to be careful when we do our fair market value calculation. Hope it works out better than this. Because if we fail this, we fail the 90% test. The shares must not have been owned by by another non-related person in the past 24 months. So in the past 24 months, either I have to have owned the shares, or maybe I bought them from a related person, that's okay. But if I bought them from you, that's not okay. I have to wait a 24-month holding period before I sell the shares if I want to claim this capital gain exemption. So here are some facts on this company. It's a manufacturer. Ding, 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 active business. So far, so good. It operates only in Canada. Even better. There's also a rule that says that, and I'm reading back again on page 374, more than 50% of the fair market value of the assets must have been used in an active business over the last 2 years. So we're looking backward now, 2 years into the past. More than 50% of the assets have to be active business assets during that period. And here's a fact I will give you. The balance sheet has looked pretty much like this since this person bought the company in 2007. So you got two good things there. Firstly, the balance sheet does look, or the assets do look like they're more than 50%, because this is only 20 out of 155. So far, so good. And this person's owned the company personally since 2007. Therefore, the 24-month holding period test has been met. And it doesn't matter who they bought them from back in 2007, as long as they or somebody related to them has owned the shares for 2 years, we're good.
Can I ask you a question?
Sure.
It says here that it's more than 50% of the fair market value of the assets. So you're looking at the balance sheet, which would be the book value.
Correct. I will give you information, as I did in the assignment, about whether these are close enough to the fair market value 2 years ago. And I will tell you that these numbers are pretty much like the fair market value numbers 2 years ago.
So you have to look at them 2 years ago as opposed to now?
Both.
Both? Well, it has to be 50% 2 years ago, fair market value, and now.
It has to be 50% 2 years ago and continuously from 2 years ago all the way to today.
Okay,
50% and 90% today.
okay, thank you.
Welcome. So the assumption I'm asking you to make is that these numbers are pretty much what the fair market value numbers were 2 years ago. And the fair market value numbers look like this between 2 years ago and today. But today we've got an offer to buy the company for more than its equity. Therefore, on a fair market value balance sheet, which is where we're going now, what's missing?
Good.
Goodwill. So we get to add goodwill here. And how much is that?
$125?
Too fast.
Wasn't it 280 minus 155?
Got to give you one more fact, which is that the investments have increased in value. They're no longer worth only 20. They're now worth 40.
Well, then it's 105.
Goodwill is 143. Please tell us how you got that.
Well, purchase minus the equity would be the acquisition differential.
It's assets minus liabilities.
Well, same thing.
So 155 minus 38, right? Minus the 20.
So the total assets at fair market value is how much?
Well, I adjusted that afterwards.
So then what you're going to do is replace 117 with 280?
I did 280 minus 117 minus the fair market difference in investment, so minus another 20. You get 143.
That's good. So how did everybody else do it, or did you come to the same number a different way?
280 less total assets, less the total liabilities. 280 minus 175, less minus 38.
Correct. Any other ways? Is anybody confused? I'll pretend I'm confused. I always do this, and I actually write this down. Assets equals liabilities plus equity. And what this says is somebody's willing to pay me $280 for the equity. So if I take $280 and I add the fair market value of the assets, pardon me, if I add to it the liabilities, I get total assets at fair market value of $318. And the assets other than goodwill are worth $175. Because if I add up 20 and 5 and 10 and 140 for the investments, that gives me 175. So my total assets are worth 318, and the assets that are not goodwill are 175, and the difference between those is 143. Any way you come to it is fine with me. It's just that I'm old school and I have to start from what I know, which is that assets equals liabilities plus equity.
You should stick a 0 in the end of that 3 above the 318, so that if anybody's looking back, they'll see that's a 30. 28 plus 8 plus 30.
Thank you. 280 plus accounts payable of 8 and mortgage of 30, 318. Just going to clean up the board a little bit. So let's now do this balance sheet again, but in fair market value terms. How much is total liabilities and equities?